In this video, we're going to revise monetary and physical policy. The main objective of this chapter is to understand what is monetary policy and physical policy and how it has impact on the aggregate demand. So this is reading 16 of CFA Level 1 curriculum. So let's start with the reading. Physical policy. Fiscal policy is what the action taken by the government by the way of government expenditure as well as government revenue, that is taxation. So, the fiscal policy may be a budget surplus or a budget deficit. That is, when government spend more whatever it is collecting in the form of taxes, then it is termed as budget deficit. But when government spending less than what it is collecting, then it is called as budget surplus. So the government expenditure is greater here, the government revenue is greater here, the government expenditure is greater here. So when government revenue is greater than what it is expending, so it is a contractionary policy. That is, it is not expecting to further growth in economy, so the aggregate demand curve decreases. And when uh, expenditure is more upon the more than the revenue, then it is an expansionary policy where the aggregate demand also increases. And monetary policy is action taken by the central bank of a nation. So the action can be an expansionary or a contractionary action. In expansionary, the money supply will increase by the central government. So the interest rates will decrease in order to lend those money. Aggregate demand also increase due to many people are willing to borrow money at a lower interest rates. So money supply in contractionary policy, the money supply reduces and interest rate increases due to lower money supply, lower money available to the borrowers, and aggregate demand as a whole decreases. What is money? Money is generally accepted medium of exchange. And what are the functions of money? Functions of money are it is accepted as medium of exchange. It has a value and it can be stored for future transactions too. The money can be termed as narrow money as well as broad money. The narrow money describes us that whatever we generally regularly see in our cash, that is notes, coins in circulation, bank deposits are termed as narrow money. A broad money is termed as narrow money plus illiquid assets, that as notes, uh, treasury bills are treated known as liquid assets. The broad money includes both narrow money as well as illiquid asset, that is notes and as well as treasury bills and all of this. So money aggregates are determined by the Fed as well as European Central Bank. So this is a money aggregate given by the Fed, European Central Bank, where it is the money aggregates are into divided into three aspects. That is three. It is the money will get broader when it move from one aggregate to next aggregate. So you can see that currency in circulation plus overnight deposit plus deposits maturing in till this, it is an M1 money. When we add deposits maturing up to 2 years and deposit redeemable at a notice and repurchase agreement, uh, and money debt, then we'll get M3, and at this point we'll get M2. This is a total money aggregate available in an economy. So what is fractional reserve banking? The term fractional reserve banking means that whenever people deposit money in a bank, the bank thinks, but we all don't withdraw or deposit at the same time. So what banks do is a bank lend our money to the borrowers who are in need of money. So what is money supply is actually is money multiplier into monetary base. So monetary base is what a currency which we have, that is Fed currency, reserve currency, and government money. In money multiplier, how many times money is circulating in an economy, that is money multiplier. So money multiplier can be defined as 1 by reserve required ratio. So total money multiplier into monetary base is a money multiplier into monetary base is the total money supply in economy. So quantity theory of money. What that we already discussed quantity theory of money in our earlier topics. So what is let's discuss again. MV is equal to PY. Money supply into velocity is equal to price into uh, income. So by keeping velocity as well as income, by keeping velocity and income constant, because they change slowly. Even if they change, the velocity offsets the increase in price, increase in income. So when money supply increases, the price increases and inflation increases. When money supply decreases, price level decreases. So monetary policy is used by the government to regulate inflation factor, especially. So generally, money can be held by people for three main aspects. What is transaction purpose? What that is purchase of goods and services like for current consumption, and precautionary motive, any uncertain events occur in future due to which to be secured, we will keep some amount of money as a precautionary purposes and speculative motive. Uh, what we use this money for wealth creation or speculative purposes. And role and objectives of central bank. What are the role and objectives to be had by a central bank? The role of a central bank is it is a supplier of currency. It needs to print currency and it lends money to the government as well as other bankers, and it regulates the payment system of uh, economy. And it is a lender of last resort. When no one has money with them, the central bank has to print the new money and release new money into the market, and it holds the gold and foreign exchange currency in order to uh, have value for the currency and not to have excess fiat money. And conductor of monetary policy. The monetary policy is determined by the central bank itself. And what are the objectives? Objectives are divided into primary as well as additional objectives, where the primary objective of monetary policy is to control inflation, and additional objectives are to achieve stability in exchange rate, full employment in economy, positive economic growth, moderate long-term interest rate, and interest rate should not be so high. For identifying inflation, we use target inflation, where we'll we will set a target for like 5 to 6% is the inflation rate for the economy, and we will try to achieve the target. So we'll base our monetary policy based upon the target inflation rate. And picking is what we'll do. We will try to do our match our inflation rate with that of a developed country or another country. So uh, you can see here, you can see the graph here that when money supply increases, the effective rate of interest in an economy decreases due to increase in money supply. The bank's resource increases severely, so they, in order to lend those money, they need to reduce the interest rates. So you can see in the graph that when money supply increases, the interest rate decreases and aggregate demand remains the same. And Fisher's effect is what say that rate of nominal rate is equal to real rate plus expected inflation. But investor as an risk risk averse, what he do is he also add an risk premium that is due to uncertainty in future payments. So return on nominal return is equal to real return plus expected inflation plus return premium, risk premium. Sorry. And unexpected inflation is positive and negative. That is, we have expected an inflation of 5%. Actually the inflation is 6%, but here the inflation is 4%. So 6% we have a positive unexpected inflation of 1%. Here a negative unexpected inflation of 1% here too. So in this case, a borrower profits from this, because when the interest rate includes both the inflation premium as well as real return. When borrowed, but actually inflation is higher, so he's paying the more percent of inflation premium than the real return. So borrower profits, but the lender losses. So this is the case in entire things. So if inflation increase, people buy bonds because they don't want to lose the purchasing power of money. So interest increases at a lower prices. Cost of holding money increases because inflation is eating away the money. So transaction cost for purchasing security will also increase, but due to the technology and technology aspect, the transaction cost is getting lower and lower. Whenever whenever we are in need of money, we will sell the bonds and then get our cash. So let's start with monetary policy. Monetary policy tools. By using what are the monetary policy tools which the central bank can use in order to control or change aggregate demand? Let's briefly discuss about all of these. Policy rate is what banks borrow from central bank. So the interest rate at which the banks borrow from central bank is also called as, in Fed it is called as discount rate, but in European central bank it is called as refinancing rate. Repurchase agreement. Repurchase agreement where central bank, commercial bank borrows money from central bank by taking a security, and later it will repay at an higher portion than what it has repaid. That is interest rate. It will repay along with interest. Reserve requirements. The central bank regulates the commercial banks to maintain high reserves, which will lead to decrease in money supply. So the interest rate will be high. But however, when reserves are reserves required to be maintained are low, determined by the central bank, then money supply in economy increases. So the interest rate also decreases in order to lend those excess money supply to the customer. Open market operations. The government can buy and sell the government securities in order to regulate money in the market. When there is excess money in the market, government will issue government bonds and securities so that it can so money supply in the economy will reduce. Federal fund rate is interbank loans taken for maintaining the reserve requirements of determined by the central bank. Monetary transaction mechanism is what monetary policy have how monetary policy have an effect on price level and inflation change. So price level inflation change occurs through short-term rates, price level, exchange rates, and expectations. Let's analyze each of these. When aggregate demand decreases, when short-term rate increases first, aggregate demand decreases. So the, when short-term rate increases, aggregate demand decreases. Less positive NPV projects. So the investments decrease, investment opportunity decrease due to which aggregate demand decreases. Also, let me tell you again. When short-term rates increases, people will stop. People will not borrow more, so that uh, even when cost of capital even increases, because people will choose an opportunity cost, that if they need to invest in an industry, they need to compensate with the interest rate, because so that investment opportunities will have a lower projects, because they can accept less NPV projects, because when discounted with a higher interest rate, the value will be lower, so the NPV projects for huge cannot be accepted, so aggregate demand as a whole decreases. And price level, so when price of bond decreases, the discount rate increases, the for consumption it decreases, and investment savings increases. So to restore the wealth, the consumers need to save more in order to compensate the reduction in wealth. So when price of bonds or securities decreases due to increasing discount rates, people stop consuming because they need to invest in order to restore the wealth which they had lost due to the increasing interest rates. Exchange rate. When there is an increase in exchange rate, FDIs are interested to invest in our country, so the demand for domestic currency increases, so domestic currency appreciates, the foreign currency depreciates, so exports decreases and imports increases due to appreciation in home currency, the aggregate demand overall decreases. And the finally expectations, that is when there is less expectations about the future growth, then growth will also be lower. Qualities of an effective central bank. A central bank should be independent, that is it can determine its operational as well as target levels by its own without interference of government. So operational independence is what determine the central bank can itself determine the target level of inflation, and target level is how it can compute inflation. Majority of countries have operational inflation rate, but they are lacking with target inflation. But European Central Bank has and both operational as well as target inflation with the central bank, European Central Bank. So credibility, it should be credible and transparent. Is that what how inflation is determined? What are the indicators which affects inflation to rise higher is disclosed to the public periodically, so that it should be transparent. What is relationship between monetary policy, economic growth, interest, and inflation exchange rate? So relationship is what we need to understand. Let's understand with the flow. When central banks buy securities, money supply in the economy reduces. That will results in increase in bank reserves, because bank have now excess reserves, so that bank have more liquid assets. In order to lend those assets, bank need to reduce. In order to lend all those money, bank need to reduce their interest rates. So then short term interest rate decreases. By consequence, long run interest rate also decrease. Money supply in economy increase. Sorry, when central bank buys securities, money supply increases in economy. So there's an impact of increase in bank reserves. So the bank lending rate will reduce, short-term rate reduce, long-term rate reduce. Money supply in economy increases because they are buying. Because central bank is buying securities and giving money to the banks or individuals. So in real interest rate decrease. So the domestic currency decrease, that is depreciates. Foreign direct investment too is not interested when there is excess money supply. Investment in plant increase due to lower interest rate, and consumption increases due to less attractive opportunities for investment. So exports increases, aggregate demand increases, inflation also increases due to increase in money supply. People have more money, So the inflation is higher and employment opportunities are high due to increase in investment. They can employ new opportunities and GDP as a whole increases. But asset prices increases due to low discounted. Before an asset is having a before a bond is having a price, but now due to decreased interest rate by discounting with a lower discount factor, the YTM of bond increases, so the asset prices also increases. Interest rate targeting. So in order to banks, what the banks do is they try to target interest rate, that is the bank want to do like 5% is the interest rate they need to achieve in the country. Based upon that they will print the money and supply money in the economy. Inflation targeting. They target, as I told you this earlier, they need to target an inflation of 6%, and they need to do a money supply as well as interest rate based upon the target inflation. Exchange rate targeting is what our one country is targeting its inflation with that of other country. Like you can see, $1 is equal to 72 rupees, 72 Indian rupees. So newly it happened to decrease to 70. That is dollar appreciates. Then buy rupees from currency market, so that money supply of rupees decrease and interest rate increase again back. And conversely, it is a vice versa case when $1 is 70 and it reaches to 72 rupees. Sell rupees in currency market so that money supply of rupee increases and interest rate decreases. By that, it can achieve exchange rate targeting by keeping the constant exchange rate in between the countries. So, limitation of monetary policy. What we have discussed is when money supply decreases, interest rate should increase. But what these bond market vigilantes and these people think that when there is an increase in money supply, when there is a decrease in money supply, they will think that their future there's a chance for recession, huge decrease in prices, and everyone will suffer. So what they do is they will buy more bonds in order to increase in interest rate. Actually, the YTM of bond is decreasing because people are buying more of bonds even when money supply decreases. Actually, the money interest rate should increase due to decrease in money supply, but it is not actually happening in that way. The interest rate is decreasing even further due to YTM increases because people perception that there is a recessionary environment in future. So in against is conversely, when money supply increases, people think that is a high inflation situation, bonds are not that well to hold, so they will sell bonds so that interest rate on bonds will increase. YTM interest rate here is YTM increases on bonds. And liquidity trap is that even when money supply increased by the government, some people are not willing to invest or buy securities. They simply hold cash, but so that doesn't have any impact on the monetary policy. So it is a limitation of, and quantitative easing is what when government buys the securities in order to increase money supply. That is, the government is issuing new bonds. Government is buying back its bonds. So then money is released into the market, but banks are not unable to lend those money, which will uh, not increase interest rate. So that interest rate is remains the same. So you can see that increase in money supply and decrease in policy rates, lending rate increases because it is not a good situation and it is deflationary situation. It is not good. Physical policy. Physical policy is dependent on the government expenditure as well as government revenue. So spending is an expenditure and revenue are the tools which the fiscal policy can do with. Spending tools, transfer payments. Government can issue pensions to the people and currency spending. Current spending, that is purchase of goods and services on the economy. And capital spending is what government do, like infrastructure investment in roads and public expenditure. So it will give an growth in economy. So due to the spending tools, it can boost growth and decrease unemployment and increase in infrastructure and make people to have at least minimum standard of living. So revenue tools is what the government receives its revenue from direct tax and indirect taxes. Direct tax, and revenue tool should attributes contains efficiency. There is an efficiency in taxation system. It should be simple, and horizontal request equity and vertical is equality. Fairness in taxation system, that is People should be charged equally, and it is based upon the percentage of income and sufficiency. Taxation should be sufficient in order to compensate the spending of economy. What are the advantage of fiscal policy? It can impact social policy. That is, it can restrict the consumption of harmful goods such as tobacco by imposing higher taxes. And it is quick implementation of indirect taxes is so quick to implement. And disadvantage of fiscal policy is that direct taxation and transfer payments takes time to implement, and capital spending, it takes long time to implement because capital spending is not done within an year. So physical multiplier, what does physical multiplier is that when government spending increased by $1, what does it has an aggregate demand on how much impact is that on aggregate demand, because whatever the money the government spends, it is circulated among many people in the economy. So how much money is circulated in economy due to increasing uh, how much spending increases due to increase in government spending, $1 of government spending. So it can be calculated by using formula. Financial physical multiplier is equal to 1 by 1 minus MPC to 1 minus taxation. So $1 increase in spending have impact on demand. Balance budget multiplier is what, in order to compensate $1 increase in government spending, the government need to collect back taxes. So what is an impact of $1 increase in tax on the effect of demand, aggregate demand? So balance budget multiplier is marginal propensity to consume into physical multiplier. So net impact on aggregate demand. What happened to the aggregate demand? Because $1 increase in spending and $1 increase in taxation have leads to increase in aggregate demand. Whether aggregate demand increase or decrease, so the government will try to achieve increase in aggregate demand. Net impact of aggregate demand should be positive. Ricardian equivalence states that when current deficit increases, that is government spending more than what it earns, it is expecting that to collect more taxes in the future. So the taxpayers also save more in order to repay the interest as well as principal portion. So the net effect of aggregate demand is equals zero. This is called as Ricardian equivalence or Ricardian theory. Debt ratio is debt by GDP, where when debt ratio is high in an economy, interest rate should also be high. So what happens is government sells more bonds, so supply increases, price decreases, interest rate increases. When interest rate is high, debt is more risky now. When interest rate on government debt is more than GDP growth, debt ratio is high. When interest rate on government debt is low when compared to GDP growth, the debt ratio is low. Here it is more risky, here it is less risky. And implementation and difficulty of physical policy. Uh, Generally, physical policy cannot be by physical policy, it will take some time to implement in an economy, because when there is a need for a policy to take action, that is, it is necessary necessary for the nation, it will take time for recognition purposes. So there is a recognition lag in an implementation. Later, when the policy is recognized, they need to take decisions. So they cannot take immediate decisions. There's a time lag in between recognizing the need as well as implementing the decision. So it is called as action lag. When policy is determined, it need to implement. So the it takes till implementation, there is an implement impact lag. So there are some other issues in implementation. The use of physical policy is that misleading economic statistic. That is, when there is a very good employment level, by doing more expansionary policy, by increasing more government expenditure will lead to increase in inflation, increase in price levels of a good in country, and crowding out effect due to severe government spending. The private investments are eroded. Supply shortages, when there is a shortage in supply, that producers are unable to produce the goods. Doing more expansionary policy does not solve an issue. Limits to deficit, when the government is expending too more, the physical deficit increase severely, and it will cause to increase inflation rates higher. And multiple targets, when the government want to reduce unemployment and reduce inflation, it cannot do both at a time. So it cannot achieve multiple targets by using physical policy. So they need to have a combination of fiscal and monetary policy in an economy. Let's understand interaction of, okay, let's see this last thing. uh, when increasing deficit or decreasing surplus means expansionary policy, because when government has deficit, it is having more deficit, then it leads to expansionary policy. But however, government is having surplus now, due to expansionary policy, it is spending more, it will have a negative balance, so the surplus balance reduces. So it is an expansionary policy. When decrease in deficit or increase in surplus, suppose country has deficit balance now, when there's a surplus in now, there's a negative balance out of which, so the deficit will reduce when there is a surplus in the present year. And when surplus increases, that is country already having surplus plus we are adding surplus, then uh, it is a contractionary policy, and surplus increases, it is a contractionary policy where the revenue is more than the expenditure. So interaction of monetary and physical policy. Physical policy, monetary policy will compare with that of interest rate, real output or GDP, private spending and public spending, where physical and monetary are expansionary policy. Physical policy have impact on government spending. So private spending and public spending depends upon the physical policy, and monetary policy depends upon the interest rate and output. So we will monetary policy based upon interest rates mainly. So expansionary physical policy, where interest rate decreases due to heavy excess money supply, and output decreases in an economy. Real output increases in an economy due to increase in interest rate and expansionary fiscal policy. Private spending increases, public spending increases. Contractionary policy, because contractionary monetary policy, interest rates increases due to lower money supply, and output or real GDP in an economy will decrease due to contractionary, that is no more reducing the government expenditure and collecting more taxes, the output or GDP will reduce. So the private spending also it decreases due to higher interest rate. Public spending also reduces due to contractionary policy. Expansionary fiscal policy have an effect of increase in public spending and increase in output, and contractionary policy have an effect of increasing interest rate and decreasing private spending, because people was unable to borrow the money at higher interest rates. Contractionary fiscal policy and monetary policy. Contractionary fiscal policy, that is government spending is less, so aggregate demand or output will be lower, and public spending will also be lower because it's a contractionary policy and revenues is more than expenditure. But expansionary monetary policy have in decrease in interest rate, because at lower money supply, interest rate higher money supply, interest rate should be low, and private spending will be high when there is an lower interest rate. Thank you.